Davos, Switzerland, January 2025. The world's most powerful leaders gathered in one room. Billionaires, central bankers, heads of state, and one man stood up and said something that should have made every headline on the planet. Gold is now the second largest currency. Not the euro, not the yen, not Bitcoin. Gold. And if you don't understand why that matters, if you don't understand what's happening right now with your dollars, your savings, your retirement accounts, you're about to learn a very expensive lesson. Because while you were sleeping, while you were watching Netflix, while you were scrolling through social media, the smartest money in the world quietly made a decision. Doctoral banks, sovereign wealth funds, the people who manage trillions of dollars, they looked at US Treasury bonds and they said, no, thank you, we'll take gold instead. Why? What do they know that you don't? Let me show you exactly what's happening. And more importantly, what you need to do about it before it's too late. Here's what nobody's telling you. The game changed, and most people haven't noticed yet. For decades, the playbook was simple. Governments issue bonds, central banks buy those bonds, central banks buy those bonds. Everyone's happy. The US gets to borrow money cheaply. Bond buyers get a safe return. The system works, but that system just broke. And the people running it know it broke. They're just not telling you. At Davos, one of the world's most successful investors laid it out in terms so clear that even a child could understand. When you have very little debt relative to your income, you can increase it and it's not a problem. But the more debt and debt service you have, the more it squeezes out your spending. That's when financial problems start. This applies to you. It applies to countries. It applies to everyone. The United States government now has $38 trillion in debt, and they're paying over $1 trillion per year just in interest. Not paying down the debt, just interest. More than defense spending, more than education spending, just interest payments on money borrowed years ago. $1 trillion per year. That's $3,000 for every man, woman, and child in America. Every single year, forever. Just to service existing debt. And here's where it gets ugly. One man's debt is another man's asset. When the government issues a bond, somebody has to buy it. China, Japan, pension funds, your retirement account. Somebody has to hand over their dollars and say, yes, I'll lend you this money. But what happens when nobody wants to buy anymore? This is the supply and demand problem that's currently breaking the global financial system. The world already holds mountains of that debt. And now the government needs to sell a lot more because deficits keep growing. So the question becomes very simple. Do you want to buy a lot more? And increasingly the answer is no. Why? Two reasons, and both should terrify you. Reason one, the return isn't good enough anymore. If you're a foreign central bank holding US dollars, you're looking at treasury bonds and doing basic math. The bond pays 4%. Inflation runs 3 to 4%. Your real return is 0, maybe 1% if you're lucky. Is that worth the risk of lending money to a government that's $38 trillion in debt and adding $2 trillion more every year? You start asking yourself, are there better options? And that's when you look at gold. Reason two, geopolitical risk. We're talking a lot about trade wars, but trade wars become capital wars very quickly. And if you're a foreign country holding US dollar debt, you have to ask yourself an uncomfortable question. What if the US sanctions me? What if my treasury holdings get frozen? If you're China, this isn't theoretical. This is real. You watched Russia. Hundreds of billions in foreign reserves frozen overnight, gone. Not because Russia didn't own them, but because they were dollar denominated and held in Western systems. So if you're China or Saudi Arabia or any country that might find itself on the wrong side of a future conflict, why would you keep reserves in dollars? Why wouldn't you diversify into something that can't be frozen, can't be sanctioned, can't be taken away? That's gold. Gold doesn't care about politics. Gold doesn't care if you're friends with Washington or enemies. Gold is just gold, physical metal in a vault you control. And that's exactly what's happening right now. Central banks are moving to gold, not slowly, not gradually, rapidly. Month after month, they're selling treasuries and buying gold at a pace we haven't seen in decades. In 2025, gold went up 67%. Not because of retail investors buying jewelry, because central banks and sovereign wealth funds were buying thousands of tons of physical gold. 67% in 1 year. While your advisor was telling you to stay in stocks and bonds, let me tell you about someone who learned this lesson the hard way. Michael was 58 years old in 2020, successful engineer, cautious investor. He had accumulated $900,000 over 30 years of disciplined saving. He was 6 years away from retirement and feeling good about his future. His advisor put 60% of his money in bonds, treasury bonds, the safest investment in the world, they said, the bedrock of every retirement portfolio, government guaranteed, risk-free. Michael believed them. Why wouldn't he? That's what everyone said. That's what all the experts recommended. In early 2020, a few people started saying you should own gold, that debt levels were getting dangerous, that the Federal Reserve was printing too much money, that bonds were going to get destroyed. Michael's advisor laughed at those people. Gold bugs, he called them. Paranoid conspiracy theorists. He showed Michael charts proving that bonds had outperformed gold for 40 years. He said the fundamentals were strong. Stay the course. So Michael stayed the course. Then 2022 hit. Interest rates that had been at zero for over a decade suddenly jumped to 5%. And when interest rates go up, bond prices collapse. Michael's bond portfolio that saved 60% lost $270,000 in 18 months. Almost a third of his retirement savings vanished. He called his advisor in a panic. The advisor told him, "Don't worry, it's just a paper loss. Bonds always recover. Just hold on." But Michael didn't have time to hold on. He was 60 years old. He needed that money to compound for retirement, not to sit there losing value. By 2024, Michael's $900,000 had become $630,000. He'd lost almost 30% of his life savings, not from gambling, not from speculation, from following conventional advice, from owning treasury bonds, the safest asset in the world. Meanwhile, gold went from $1,800 an ounce in 2020 to over $3,100 in early 2026. Someone who put that same money into gold would have turned $900,000 into $1.5 million. Michael versus the gold investor, one lost 30%, the other gained 67%, same time period. The difference? Understanding what was actually happening instead of trusting conventional wisdom. I saw Michael last month. He's 64 now, still working. Not because he loves his job, because he has no choice. His retirement got pushed back indefinitely. The vacation home he dreamed about, gone. Early retirement, gone. His golden years became his working years. And here's what destroys me about his story. His advisor, still telling new clients that bonds are safe, still collecting fees, still recommending the same portfolio that destroyed Michael's retirement. The advisor didn't lose anything. Michael lost everything. Now let me show you the flip side. The people who understood what was happening. I know a woman named Sarah. She reached out in 2021 after reading about debt cycles and monetary policy. She was 52 years old. School teacher. She had $450,000 saved for retirement. Her advisor had her in a standard portfolio, stocks and bonds. Sarah asked about gold. Her advisor said no. Gold doesn't pay dividends. Gold is a speculation. Stick with a proven portfolio. But Sarah did her own research. She looked at history. She saw what happened in the 70s when inflation hit. She saw what happened every time governments printed massive amounts of money. She saw the pattern. So she ignored her advisor. She moved 15% of her portfolio into physical gold, $67,000. Her advisor told her she was making a mistake. Her friends said she was paranoid. Everyone said she was crazy. From 2021 to early 2026, here's what happened. Her stocks went essentially nowhere after inflation. Her bonds lost value as rates rose, but her gold position, 67,000 became 112,000. A 67% gain while everything else was struggling. That $45,000 gain on her gold position offset most of her bond losses. While Michael was watching his retirement dreams die, Sarah was on track. She'll retire at 60 as planned. Comfortable. Secure. Protected. Same economic environment, same financial crisis. Two completely different outcomes. The difference? Sarah understood that central banks were moving to gold. Michael trusted his advisor, who was still living in the old world. Your advisor works in the old world, the world where treasury bonds were safe, where the dollar was stable, where the system worked. That world is over. Central banks know it's over. That's why they're buying gold at record levels. Sovereign wealth funds know it's over. That's why they're diversifying out of dollars. The smartest money in the world knows the game changed. But they're not going to tell you. They're going to keep taking your money and putting it in the same portfolios that destroyed Michael. And in 5 years, when your retirement is gone, they'll say nobody could have seen it coming. Except people did see it coming. Sarah saw it coming. Central banks saw it coming. Anyone paying attention saw it coming. The question is, will you see it coming? Or will you be the next Michael? Here's what you need to understand. Throughout history, money has only been two things: hard money or fiat money. Hard money means currency linked to something real, gold, silver, something limited in supply. Fiat money means currency backed by nothing, just paper or digital numbers. Governments can create as much as they want. Both systems work until they don't. With hard money systems, countries link currency to gold. Everything seems fine, but then government spends too much, fights wars, accumulates debt. Suddenly they have more promises than gold. Two choices emerge. Choice one, stick to the commitment, keep the gold link. But that means defaulting on debts, deflationary depression, asset prices collapse, businesses fail, unemployment explodes. This happened before central banks existed, before 1930 in the United States. Government stuck to gold, and when debt got too high, brutal deflationary depressions followed. Choice two, break the commitment, print money, create currency to pay debts. But now, it's not backed by gold anymore, just paper. And as you create more, each unit becomes worth less. Inflation, sometimes hyperinflation. After central banks came into existence, this is always the path chosen, always, because politicians would rather inflate away debt than face depression on their watch. And here's the key. In the inflationary path, gold explodes in value, not because gold becomes more valuable, because the currency becomes less valuable. You need more dollars to buy the same gold because each dollar is worth less. This happened in the 1930s when the US broke the gold link. Gold revalued from $20 to $35 overnight. 75% increase. It happened in the 70s when Nixon closed the gold window. Gold went from $35 to over $800, 2,300% increase in less than a decade. It happened in the 2000s after the dot-com crash. Gold went from $250 to $1,900, and it's happening right now. Gold went up 67% in 2025. And we're just getting started. We've been in a purely fiat system since 1971. 55 years, no link to gold whatsoever, just central banks creating money from thin air. And in every fiat system throughout history, the same thing happens. Currency gets debased, inflation destroys purchasing power, and gold becomes the ultimate store of value, not because gold does anything. Gold doesn't earn dividends. Gold doesn't produce anything. Gold just sits there. But that's exactly why it works. While dollars lose value, while bonds get destroyed by inflation, gold holds its purchasing power. It's the money that doesn't fall when everything else is falling. Now, here's where most investors make a catastrophic mistake. They treat gold like a speculation, like a stock. They ask, should I buy gold today? Will it go up tomorrow? Wrong question. Completely wrong. Gold is not a speculation. Gold is money, the safest form of money. The question is, how much of this safest money should I own as part of my portfolio? This is strategic asset allocation versus tactical trading. Strategic allocation means deciding what percentage should be in different asset classes based on long-term characteristics: stocks, bonds, real estate, gold, cash. You figure out the right mix and stick to it regardless of daily market moves. Most investors can't do tactical trading successfully. They think they can, but they can't. They buy high when everyone's excited. They sell low when everyone's panicking. They underperform. Simple, buy and hold. So your starting point should be strategic allocation. Figure out what mix you should own. Then only deviate if you genuinely have better information than the market. For gold, the strategic allocation should be between 5 and 15% of your portfolio. 5 to 15%, not a speculation, not a bet, a permanent allocation to the safest money that exists. Why 5 to 15? Because that's enough to protect you if the system breaks, but not so much that you give up too much potential return from productive assets. Think of it like insurance. You don't put 100% of your net worth into home insurance, but you keep enough insurance to protect yourself if disaster strikes. Gold is insurance against monetary system failure, against currency debasement, against governments doing stupid things with money, which they always do eventually. And here's what should wake you up. Most investors own zero gold, not 5%, not 1%, zero. They own stocks, bonds, real estate, but zero gold. That means they have zero insurance against the exact scenario playing out right now. Central banks printing money, debt spiraling, inflation destroying purchasing power, and they're completely exposed. When the crisis accelerates, and it will, those investors will panic. They'll watch bond portfolios get destroyed, stock portfolios cut in half, and they'll have no protection. Sarah had protection, Michael had none. That's the difference between comfortable retirement and working until you die. Now let's talk tactical positioning. When should you overweight gold above 5 to 15%? 3 scenarios. Scenario 1, monetary system breakdowns. When debt becomes unsustainable and central banks print massive money to cover it. That's happening now. US debt to GDP is 125%. They're about to print trillions more. Scenario 2, high risk of money confiscation when governments threaten to freeze assets, impose capital controls, or sanction foreign holdings. Happening now. Look at Russia. Look at China rhetoric. Scenario 3, economic and monetary wars. When trade wars escalate into financial wars, when countries weaponize currencies and financial systems against each other. We're in early stages now. We're in all 3 scenarios simultaneously. This is not normal times. This is crisis times. Most people just haven't realized it because stock markets are still near highs. But smart money knows. Central banks know. Sovereign wealth funds know. That's why they're buying gold at record pace. You need to understand something critical about gold. Gold has lower confiscation risk. It doesn't depend on getting money from someone else. It's not a promise. It's not a contract. It's physical metal you own and control. Stocks are a promise that a company will be profitable. Bonds are a promise that government will pay you back. Real estate depends on legal property rights enforced by governments. All of those can be confiscated. Stocks can be nationalized. Bonds can default. Property rights can be violated. But gold is gold. If you own physical gold in a secure vault you control, nobody can take it without physically breaking in. This is why during wars, revolutions, and monetary collapses, gold has always been the ultimate safe haven. It can't be printed away, defaulted away, or confiscated with a signature. Over centuries, gold has the best track record of holding purchasing power, not making you rich, just preserving what you have. An ounce of gold 2,000 years ago bought you a nice suit of clothes. An ounce today buys a nice suit of clothes. The purchasing power stayed the same. Meanwhile, every single fiat currency that's ever existed eventually went to zero. The German mark, the French franc, the Roman denarius, everyone. Given enough time, they all get debased into worthlessness. Gold survives. That's why it's now the second largest currency held by central banks. They know this history, they know what happens to fiat currencies, and they're protecting themselves. While they protect themselves with gold, your advisor is putting you in bonds. Now let me tell you exactly what you need to do. Not next month, not after you see what happens. Now, step 1, calculate 5 to 15% of your liquid net worth, not your house, not your business, your investable assets, money in brokerage accounts, retirement accounts, savings accounts. Add it up. Calculate 5 to 15%. If you have 200,000 in investable assets, that's 10 to 30,000 in gold. If you have 1 million, that's 50 to 150,000. Step 2, buy physical gold, not gold mining stocks, not gold ETFs, physical gold coins or bars you own, American Gold Eagles, Canadian Maple Leafs, gold bars from reputable refineries. Go to a reputable dealer, APMs, JM Bullion, local coin shops with good reviews. Yes, you'll pay a premium above spot price. Usually 3 to 5%. That's fine. That's the cost of owning real metal instead of paper promises. Step 3. Store it securely. Small amounts, a home safe works. Bolted to floor, fireproof, hidden. Larger amounts, professional vault storage. Brinks, Loomis, or offshore storage in Switzerland or Singapore. The key is you need to own it, not a bank's promise, not shares in a fund. Physical metal allocated to you specifically. Step 4. Ignore everyone who tells you this is crazy. Your advisor will say gold doesn't pay dividends. Friends will say you're paranoid. Financial media will call you a gold bug. Ignore them. They don't understand what's happening. They're still living in the old world where treasury bonds were safe and dollars were stable. That world is over. Step 5. If you believe we're in a true crisis moment, and all evidence suggests we are, increase your allocation above 15%, maybe 20, maybe 25. Central banks are buying at record levels. Gold went up 67% last year. Debt is spiraling. Geopolitical tensions are rising. All signals are flashing red. This is not the time to have zero gold. This is the time to be overweight. Here's what's going to happen. Most people watching this will nod along. They'll think, yeah, this makes sense. Gold as insurance, 5 to 15%. Got it. And then they'll do nothing. They'll check their accounts, see everything's still up, think everything's fine, and they'll miss the window. There's always a window, a period when you can reposition before crisis becomes obvious to everyone. Once it becomes obvious, it's too late. The price has already moved. We're in that window now. Gold has moved, yes, but it's nowhere near where it's going. Central banks are still buying. Sovereign wealth funds are still buying. Smart money is still accumulating, but that window won't stay open forever. Maybe 6 months, maybe 12 months, but not 5 years. At some point, probably sooner than most think, something will break. Maybe a treasury auction fails. Maybe a country defaults. Maybe a bank collapses. Something will make it obvious to everyone that the system is broken. And on that day, gold will gap up 20% in a single session. And you won't be able to get it. Dealers will be sold out. Premiums will be 20, 30% above spot. You'll pay $2,000 an ounce for something you could buy today for $1,800. Don't be Michael. Don't be the person who understood the analysis, agreed with the logic, and did nothing. Be Sarah. Be the person who acted while there was still time. This is your portfolio, your financial future, your family's security. Nobody cares about it more than you. Not your advisor, not your friends, you. Turn off this video. Open your brokerage account, calculate 5 to 15% of your liquid net worth, and buy physical gold this week, not next month, this week. Because in 6 months, you'll either be glad you did or you'll be kicking yourself for not listening. The central banks already made their choice. The sovereign wealth funds already made their choice. Sarah made her choice and she's retiring comfortably. Michael didn't make that choice and he's working at 64 with no end in sight. Now it's your turn.